Hi, everybody. It is I. Let me just get things adjusted here 1 second. I'm running a little bit tardy today. There we go. I don't know which is better. That one, that one, that one, that one. I don't know. Hard to say. Probably right there. Nope, one more. There we go. It's hard with the mouse. Okay. I just saw the comment about the thumbs down. Yes, don't do that. Give me a thumbs up. That would be nice. Running a little bit behind, but we're on time. It's 2:33. Goal to get under an hour today. Welcome to the Financial Thing peer-to-peer lending and investment live stream. Quick disclaimer, this information is not financial advice. It's not being prepared or has been prepared without taking your objectives, financial situations, or needs into account. You should consider its appropriateness for your circumstances. All investments carry risk, and opinions expressed in this review are in this live stream are opinions based on my own personal experiences. The FSCS does not cover peer-to-peer lending, and your capital is at risk. So please don't invest more than you can afford to lose. If I seem a little bit discombobulated today, I definitely am. I'm not. I don't even have the tea. I have this strange shake concoction through lack of time today to prepare anything nutritious to eat. So we got the spinach and blueberries, oats, not particularly great tasting. But yeah, glad everybody's here. What's the date today? Thursday, September the 10th. What are we talking about today? Got some house crowd information, some FCA stuff, a little bit of Ratesetter news, Moneything news, Growth Street, Funding Secure, Lendy. We're going to talk about ISAs today, peer-to-peer lending ISAs. I had an interesting conversation with a gentleman this week about a possible new project that he's launching about how to make ISAs more accessible to people and a way for them to manage it, which I found really interesting. I think ISAs has been sort of a source of contention within peer-to-peer lending in the way that you can only do certain things with your current year's ISA. So possible solution to that, which I found really interesting. We got some FCA news. It's going to be a short one today. I think we'll try to get under, I'm going to try to shoot for under half an hour this week, and we'll see whether that happens or not. Quick shout out to everybody in the stream. Stephen, you are first today. Stephen Hale in Nottingham, Tony in Somerset, Alan in Basingstoke, Paul in Cloudy Kenilworth, Stephen in Southport. Hi, Patty Gilfillan. Patty Gilfillan. That wouldn't be an Irish name, would it? Evening to you. Hi, Chica Boy. Hi, Peter Vince. Annabelle. Alan, thanks for the thumbs up. No, I'm not playing the CD. I was a little bit late. Got some things going on, but everything's all good. Hi, Martin in Leeds. Aki Chap, nice to see you in Accrington. Norman in Sussex. And Paul in Portsmouth, close to sort of where I'm from. Keith, hi in Lincoln. 30 minutes. I've got the stopwatch on me. Yes, says yes, put the stopwatch on me. I'll see if I can do it. If you have any questions or comments, pop them in the stream. I'll try to do my best to answer them as I do every week. My voice is a little bit, it seems like it's a bit lost today, so excuse that. Excuse me. Very unprofessional, but that's just the way I do things in the t-shirt with the shake. So let's get to it. I took a look at Assetz Capital this morning with the discount stuff. What's going on in the secondary market seems to be sort of the same as it was last week. People still offering pretty deep discounts. I think that's going to continue probably for the next month or two, while the people who really want to rush to get out are willing to take these discounts. I don't really foresee that changing. Do I think that's a indication of Assetz Capital's situation? No, I don't. I think that's an indication of investors' situations who want to get out quickly. I don't really take too much about it. I can't remember if I talked about this last week, but I'm really impressed with Assetz Capital security login feature that they have. If you want to log in, if you're not an investor of Assetz Capital, but if you want to log in, you need an app. Of course, I don't have my phone with me, but you're able to log in using an app as a sort of secondary function login, which I love. It's pretty much the only peer-to-peer lender that I use that has that second factor authorization. So you put your password and log in into the website, and then the app sends you a little ping message and says, somebody wants to log in, so do you accept that or approve or deny it? So once you hit accept, it logs you into Assetz website. Sure, everybody who's a Assetz Capital member knows that, but for those of you who don't, you're thinking about investing in Assetz Capital, I definitely see that as a big positive on the security function, because some of the peer-to-peer lending login functions are pretty basic, just password and username, and you can get in. So I like that. So today I got a interesting email from the house crowd. I currently have only one investment through them. It was a way for me to test the platform. I've been wanting to try it out for a while, but I wasn't really convinced that the house crowd was a place that I personally wanted to invest. They're all buy-to-let type properties. I'd done that before with other companies, and it just hadn't really panned out well. So I was a little bit soured on that type of investing, buying shares. And I think that might be one of the reasons why I know Assetz has a similar investment product. And I haven't really jumped into that because of past investments where you buy shares in properties and then you try to sell them in the future for a gain. Don't know that that's something I'm necessarily interested in. But what the house crowd has is other development projects that you can invest in. And I decided to, for testing, I wanted to see what the platform was like. So I invested in this project called the Downs, which is in Altrincham in the heart. I think it was about a year ago. I put in a minimum investment in there, and it was launched in October 2018. And I got an email today saying that basically it was a development piece of land, and the vendors, in order to work on the property development, wanted a legal charge on the development land of how much was it? It was over £2 million, but in second position. So you have the house crowd investors in first position, then the vendors in second position. So what's happened with the delay with COVID and some contractor issues is that the vendors want to get paid. They're owed £2.1 million now in second position on this development, and they want to get paid. And the problem is that there isn't the money to pay them because the development hasn't moved forward. There are stage payments that have been made. So every couple of months when money comes into the development, then the vendors are paid out. I think they were supposed to be paid on June 2020 was the final date. So what the vendors have said now to the house crowd is, to this development, is that we want to get paid, and we're in second position. And if you don't pay us, we will threaten to put the whole development into administration. Now, it's a big problem because, a second position lender certainly doesn't have the power that a first position lender does. However, a second position lender can, in some cases, take administrative action or legal action to put the whole development into jeopardy. It's a pretty bad case scenario for a developer and anybody that's in first charge position, because the last thing you want to see is a development go into administration. We've seen this happen a lot of times, where the loans go into default and the problems it can cause, especially when a development is in construction and it's not completely finished. It's therefore very difficult to sell. If a development is 30% complete and somebody comes and puts the development into administration, now you have to find a builder who's willing to take over this development and finish it. And as an administrator, that's very hard to do. And it gives anybody that's looking to buy that development that's incomplete a lot of power, because there's just not that many developers that are going to buy something like that. So it gives them a lot of power in price negotiations. And if they, let's say that, the total loans that are owed are $5 million and the development value is $6 million, it gives the power to somebody looking to come in and buy at a discount rate, the power to say, well, we're obviously not going to pay $6 million. We're going to give you $3 million. And that's how these capital losses occur, through administrative issues, and properties are going to default. So what the house crowd wants to do is basically put investors into a second position and to have another investor come in and finance the money that is needed to pay off the vendors. So basically, I come in as an investor and I'm sold a first position investment. Now the house crowd is coming in and saying, we want to make you a second position investor now, because we're going to borrow, or we're going to give somebody else the opportunity to raise the money, and they will go in a first position ahead of you. It's not a good position to be as an investor, because it's like you're taking in an investment that you're advertising to me and then saying, well, that didn't really pan out, so now you need to change your position. And you know how much I hate second charge investments. I think they're fraught with difficulties. If it ever ends up in court or in administration, the second charge lender gets the shaft nearly every time. So the email that I got, and I want to read this to you because I probably shouldn't be reading it to you, but I really don't care. I just want to read it and kind of go through it so you can see some of the issues and some of the things that happen during peer-to-peer lending development loans that you really don't think about when you invest inside of them. So this is the email, and I'm going to read pieces of it. But it said, when the purchase of the land was agreed, this was to be done on a stage payment process. That means payments are made at different stages through the year. As part of the legal agreement, the vendors were granted a second charge on the land until their stage payments have been made. So the lenders are owed a couple of £1 million, or whatever that amount was. And in order to make sure that they are covered themselves, they push for the second charge on the land, to which house crowd agreed to. It says the vendors have a deed of priority, which restricts the house crowd's first charge to $2.25 million until they've been paid. Okay, so what that means is if the house crowd has a £5 million loan, the second charge vendors basically had, there's a legal deed of priority which says the house crowd can only recover $2.25 million until the second charge vendor has been paid what they're owed. So it's very restricted. The email continues to say, it was the intention always to pay the remaining balance to the vendors in June 2020, but due to effects of COVID, it did not prove possible to raise the final £2.1 million owed to the vendors. House crowd developments entered into negotiations and agreed a settlement payment with the vendor, who has threatened to appoint receivers over the site. This would have been disastrous for investors. The site has been independently valued in its current state of development at around £5 million. The house crowd first charge is limited to $2.25 million, and the landowner is still owed $1.65 million. Should we not complete the project in line with how the house crowd developments are planning, or if payments are not made to the vendors and they appoint receivers, a loss of upwards of £3.75 million will be crystallized for investors, but that could be well more if no realistic offer is received. It is therefore imperative that the house crowd finds a way to fund the rest of the construction at the Downs Quarter outside of the existing investor base if we are to return capital in full and deliver the returns. Now, my question here is, why is the house crowd not raising this money on the platform? This is something that they really don't explain unless I missed it. Why bring in another borrower or another lender who's going to take first charge, put the existing investors in second charge position, which is a bad place for them to be? Why not just raise another tranche on the house crowd itself? That I don't really understand, because they've raised 5 tranches so far. So the email continues, however, to get the best rates possible, which in turn reduces an impact on investor returns. That essentially explains what they don't want to do, is raise money at 10% when there's probably a borrower or a lender who'll come in at 6%. If house crowd has to raise additional capital through their platform, let's say they do it at 10%, now this is going to reduce investor returns. So there's the answer. So the new incoming lender wants to have as much comfort as possible, so they will require first charge security over the development. Totally wouldn't blame the incoming lender for that, because I would want the same. This means that existing investors would need to move to a second charge position, in effect worsening their priority to the development. This means that you'll only be paid after, so this means me as an investor would only be paid after the new lender has received its capital and interest. Again, the financial analysis shows there is no reason why you should not receive your money and interest if this happens. Well, house crowd, there's plenty of reasons why I wouldn't receive my capital and interest back. Then they have some bullet points just to say why you should do this. It's up for a vote, and they're saying you really want to agree to this because our professional advisors are recommending this route. The risks of not agreeing to the proposal is that the project stalls or fails due to the platform not being able to raise the required funds. Doing nothing may result in the development failing and the investors losing a ton of wonga money. There's a risk that a buyer could not be found at the £5 million valuation, given the complication around the deed of the property. Which, why did you sign that deed of priority if it's going to be an issue? That's a good question. It seems like an overlooked important piece of this puzzle. There is a risk that the current gross development value may not be achieved, and that even agreeing to this proposal, there is no guarantee that the gross development value will remain at the current level, but fall. Yeah, I mean, it's just another case of, I think, maybe some overlooked important key things. The reason why this development is now in jeopardy is because of this deed of priority, which the house crowd or the developer and the landowner gave to the vendors as a way to get paid. I don't know the particular ins and outs of what happened during those negotiations, but if I'm a first charge owner of a land development, I'm probably not going to do that. I'm going to work out a way for the vendors to get paid without them having a deed of priority. So yes, give them the second charge if they need it, but a deed of priority which almost circumvents the house crowd's part, the 2.25 million restriction, seems like a mistake. which I think is now proving to be true. And now it really is a twist in the arm of people like me that have invested in this project to say, look, if you don't do it, there's a good chance that this development's going to get shut down and you're going to lose money. Now, if I had a lot of money into this development, which I don't, I mean, I have a few, like 1,000, I would be particularly annoyed because, being moved from a first charge to a second charge position investor is crap. I mean, that's not what you signed up for, right? When you took on this investment, you didn't sign up to be moved from a first to a second charge. If this had been presented as a second charge investment from the outset, most people wouldn't have invested in it. So that's not a good thing for a peer-to-peer lending or any development company to be doing to their investors. Yes, and I understand things happen. They didn't know COVID was going to happen. But delays in development, real estate development projects happen all the time. So you have to put contingencies in there to know that things could get delayed. And how are you going to pay the vendors if the project gets delayed? Seems like that wasn't really thought about. So put your views in the comments. Let me know what you think about it. I was really surprised to get that today. It was like one of those emails that you never want to see, and kind of a black mark against the house crowd, I think, on my side of things. So that was that. Inching ever so close to a Ratesetter exit. They've released £2.7 million in September. My exit personally this week. Access, I'm sitting at number 188 in the exit. It was 205 last week, and made some big jumps in the 5-year exit number 31, and I was 345 last week. So I'm imagining my 5-year exit is going to be done this week in a couple of days. Access looks like it's just going to take more time. One of it on the forum, on the not the forum, on the Facebook group, if you haven't joined up, join the Financial Thing Facebook group. Put the link in. Somebody had asked this week if they've cut their interest rates by half and exit is extremely slow, why would you not want to just hang in there and wait? And my reply, by the way, here's the Facebook group if you want to join. My reply to that is, well, number one, everybody's investment roadmaps are different. It's whatever you're comfortable with. Personally, I don't like the idea of sitting at such a low interest rate for the foreseeable future. It looks like it's going to continue until the end of 2020, if not into 2021. Personally, I'll take the whatever the exit fee is and move the money somewhere I can get better rates. And if Ratesetter does move their rates up in the future, I'd be happy to consider reinvesting with them. I just don't like the idea of being in limbo. I don't know how the Metro Bank takeover is going to affect rates in the future. They may well stay where they are, and why, I don't really want to sit around for the next 3-6 months with those low rates, knowing that they're not going to get increased. We don't know if they're going to get increased, but I don't see anything wrong with that. We're taking a percent exit. I've been in Ratesetter for several years, so I've made plenty of interest from them. But everybody's situation is different. Some people, I might say, well, if you just joined, 3 or 4 months ago, then maybe I'd consider just hedging, exiting a small percentage or a 30% of your investment and then hanging on to the rest, just so you're not taking a, because you're going to have to pay the exit fees. So that way you're not taking that haircut on the exit fees, but as the money gets repaid, capital and interest, you can just withdraw it as it comes in. I don't think that's a bad solution to that problem. It just, again, depends on your particular position and how long you've been in Ratesetter for and what your returns have been like over the years. I mean, mine have been pretty good, so I can afford to take a small fee to exit and put the money somewhere else. I might just bang it all in Tesla shares. Who knows? No, probably not going to do that. Let's see what else. Another Moneything email that I shared a tier this week. Another loan placed into default, £745,000 loan on a £4.5 million gross asset value. This was a loan that Moneything did in conjunction and partnership with ThinCats, another peer-to-peer lending platform that has ceased operating its retail arm. It was a cleared development land loan, meant that pure land. Reading it, I was thinking about, why did I invest in this loan? I think I had too much faith at the time in Moneything and what they were doing. And looking back now, land development loans for me are just, I just don't do them anymore. I don't think that's worth the risk. Some of them go well, some of them don't. Why risk it? What's happened now is there is a third secured lender who is in second charge position that said Money thinks that they do not intend to provide a deed of release. So the whole thing has gone into default, into administration now. Not a good situation again for Moneything investors, for myself. Kind of another black mark for them, another black mark for high interest rate peer-to-peer lending investing. That's why I've been saying, diversity is important. Looking towards the lower end, the lower risk, lower reward sites are definitely something that is important to do if you're an investor. So this again is just ongoing snowball of poo that seems to be coming along with Lendy, Moneything, and Funding Secure. Funding Secure sent an email this week saying they've have a sale price of £1.3 million on a loan that had been placed up for sale on a development. The loan's about 1.6 million plus. So they got the sale, they got the money, and now the borrower has raised concerns about the loan and about the appointment of receivers. So they are holding the funds until they sort out that with the borrower, who's upset. This was a 10-floor, 42 apartment development building with a gross development value of 4.37 million. Yeah, I wish I had good news this week. It seems like all of my news is not particularly good. Good news is Loanpad's doing really well. Crowd Property are doing well. I'm getting good reports from Propland. Cufflink seems to be staying the course. I had a good chat with them, by the way, this week. Completely forgot about that. I had a meet with Cufflink this week. You say they are very busy. They're getting a lot of development loans in the pipeline, and they're taking good action on the loans that they are running late or that they feel like there might be issues with. They're handling those appropriately. So that's a definite bright spot. It seems like, my top 5 list, those companies seem to be staying the course and doing what they should be doing, whereas the ones that have fallen out of favor, those Funding Secure, Lendy's, Moneything, continue to have problems. I'm not surprised about that. I think that's just part of the course of what we're going to see. And unfortunately, we're going to see, this sort of line of bad news that's going to come out when it comes to those companies for a while. So if you're new to peer-to-peer lending, don't necessarily let that news about those companies affect your potential future outlook for the general peer-to-peer lending, for the rest of the peer-to-peer companies that are doing things correctly, because there are some that are. On Facebook, I read a comment from somebody who has really been burned by Lendy in the case of putting too much money into the company when they were investing through them. said they put their house sale money and career earnings and retirement into Lendy. And, my heart goes out to that person. I'm not going to name the name, but I think, again, another lesson in diversification. If you're putting your entire life savings into a investment that's high, obviously it's high risk, 12% return, you're gonna get burned. If you don't, you're very lucky, but it's so important to diversify, not to put everything you have into one investment like that. And I feel bad when I read stuff like that. I'm going, God, why do that? But it's good to read stuff like that as a constant reminder of taking risk into your investment strategy, and why. It'll be no different from putting all your life savings into one share on the stock market and then that share going belly up. Don't do that. I guess if you got the stomach for the risk and you can afford to do it, do it. But if you're gonna put your life savings into something, don't put your life savings into anything. One single investment vehicle. It's or one single share. That's very, very risky. Would I put my life savings into an index tracker? Probably not. Not the entire thing. I'd consider a certain percentage of what I was willing to risk, but I might do like 80% into a couple of trackers, but I'm certainly not going to sink 100% of my life savings into anything. I wouldn't put 100% of my life savings into a savings account in a bank. Anyway, we've already surpassed the 32-minute. Let me go through this and then I'll look at your comments. There is a new FCA complaints commissioner, Amardeep Samal, who starts on November 1st. It's really interesting because right now the FCA is conducting a consultation that they've been doing for several weeks. It's an 8-week consultation about the complaints process. And what they're doing is looking to put limit on compensation of financial losses for people that complain through the FCA. There was a news article in the Financial Times Advisor. Two campaigners, Gina and Alan Miller, were saying that this is not right for them to put these caps on, and that considering the FCA has only paid out over £13,475 over 18 months to successful complaints, it doesn't make sense to put a 10K limit. Also, if the FCA makes a mistake, that they should really be liable to cover those losses. If the FCA regulates a criminal organization, there should be some compensation for that, for their mistakes, and putting a limit on the losses is kind of ridiculous. I totally agree with that. I think that the FCA needs to protect its consumers and not to put limits on if something happens. And there's a funding or a finance scandal, the FCA, and they shouldn't be able to limit losses. So totally agree with that. Quick, I'll talk about ISAs in a minute. I'm just going to go through your comments, see if you have anything interesting for me this week. Again, please hit the thumbs up. How many? I've got my tripod kind of covering the like button. Hold on. 19 likes today. Let's try to get that up if we can. Helps me with the YouTube search and the algorithm. Now my tripod is moving. Anyway, so hit that thumbs up. I appreciate that. I appreciate everybody being here. Let's see here. Good picture and sound. Thank you. Thank you very much. I'm glad that it looks good. Let's see. We had a lot of comments. Wow. Anyway, I'm trying to read through all your comments. Mine says he learned his own property value has gone up by 17% in 6 months. Local properties are being snapped up, and I wonder why. Yeah, it's really interesting because the property market in the US has been the same way. It's on fire right now. And again, I think it's like the stock market, very much disconnected from what's going on in the economy. Um, I think that we're going to have to look in 6 months' time and see if things are still the same. Maybe the economy, my best guess for why this is happening is people who are buying houses are not necessarily so affected like the lower income people who have been laid off from, say, in the US service positions because of restaurants, bars, um, those businesses that have failed. Those types of people are usually not in the market for property. Property buyers are normally people that have secure jobs, in the higher income brackets. Maybe they haven't been laid off as much. If you're looking at what's going on in tech right now, tech industry is still continuing to do well. People are still buying iPhones. They expect the orders for iPhones to be just as much, which means tech is doing okay. And those people in the property ladder buying positions are not as affected as the lower income people. So there you go. Hi, Chimpo, Naughty, Darren in Cambridge. Nice to see you. Also in the UK, you've got this severe housing shortage. I would imagine that COVID delays are going to delay housing developments too. So you're going to have a shortage of properties again this year and probably next year. Probably not as much being built. Yeah, I know, less than 10 minutes. I'm already over the 30 minutes, I understand. And I have a strange drink that I haven't drunk. No, I'm not going to switch off the webcam halfway through. Yeah, hacky chap, Tesla went down. I think it lost like 20% of its value in one day. It was already overvalued. Plus, Tesla's doing, I think, a $5 billion stock float. So it's just a volatile stock. A lot of the things about Tesla is people are trading it. You should see some of the things I read about the traders. There's a really interesting forum on Reddit called Wall Street Bets, and it's just a bunch of people gambling on Tesla stock. They're taking options on Tesla stock, and it's just such a volatile stock. It's a gambling stock. Did well for the people that jumped in when it was $200 18 months ago, but yeah, Tesla did not get included in the S&P 500. Annabelle says, my view on Ratesetter is although their interest rates are now very low, there's still few places you can get more at the moment, sad to say. Yeah, there are some places, Annabelle, if you stay diversified. Yeah, there's some places. Loanpad. I like Loanpad. Still think they're doing a great job. Yeah, I agree, Mike. Mike says, and we were talking about the Moneything loan. He says, interesting, there was no charges registered at the company's house other than the thin cats and Moneything charges, so quite perplexing. Yeah, I'm wondering who the heck this other lender is. So really weird. Dave is buying HFEL for income as they pay quarterly dividends and have a great track record of paying dividends. That is, I really tweaked my neck today. I don't know what happened to it. I'm looking HFEL. What is HFEL? Henderson Far East Income Limited. I don't know. David says on here dividend 0.07%, but must be a different fund because that can't be right. David says, I cannot understand why legal in general are so cheap, paying over a 7 or an over an 8% dividend. Well, let's look at legal in general's chart. So usually when a company pays a lot of dividends, they're not, they don't grow a lot. So, I think, yeah, if I'm looking at the legal in general charts over the last 1999, the price, I have to look at the, I don't know if I'm looking at the right. Yeah, I was looking at the US market. Let me look at the, probably the same. Yeah, 250 is September 11th. Let's see. So, yeah, I mean, you're looking at legal in general. I mean, if you can go back all the way to 1999 when it was 220.75, right now it's 199. So if you're a stockholder of legal in general for the last 20 years, you've seen no growth at all. You've actually seen the price of the shares go down at one point, all the way down to 34.8 in 2009, back up 279.5, and 318.4 has been its highest. So it's been a pretty volatile stock. I mean, we'll see in March, due to COVID, it dropped to 1.157, so it lost half its value. Usually when these companies have high dividend yields, they're not growth companies, and they just don't grow a lot with the share prices. Oh, and I see now. So yeah, you're right. The dividend yield is 8.8%. The last one that we talked to, the Far East Fund, was 7.4%. Yeah, high dividend yields, not much growth. So I mean, heck, if you'd have bought it, again, highly dependent on these shares when you buy them. If you'd have bought April 2015, you'd have paid 278.1 for these legal in general, and now you're at 199. But if you'd have bought it in 2009 at 24.8 and now you're at 199, you do great. So it's, again, that's why I talk a lot about market timing on these shares. It depends when you buy in. You buy in at the right time, you could do well. If you buy in at the wrong time, you can, sure, you get your dividend, but you're not getting anything in the growth. So yeah. David says, I'm in Cufflink, Dave Dawson. Just a little worried about overruns on loans, but they are dealing with the problem as well. Yeah, that's what we talked about this week. I asked them about the loans that have overrun. They're being handled appropriately. A lot of the times extensions are being put into place. COVID situation has obviously changed things a lot with property development loans. If you're a lender like Cufflinks, the last thing you want to be doing is sending loans into default. When we have this economic problem going on right now, the best thing you can do is just extend them out, work with the borrower to make sure the borrower is in good shape, and get those loans paid off in the long run. Dave says Loanpad seems okay, just put off with the lower rates. Totally understand. Yeah, I mean, low rates just suck right now. I agree. You're not going to get, you're not going to get any interest from the banks, I'll tell you that. Loanpad seems okay, put off with the lower rates. Absolutely. Chica says he would leave it all in the bank, at least until this COVID thing is over. Yeah, but the problem with that, Chica boy, is the COVID thing may not be over. And banks have been paying 1% for a while. you'll probably be looking at 1%, or I think if you could get 1% now, you'll be lucky. I know NSI, but once interest rates go 0 or negative, you're going to be paying money to the banks to have your money there. You will. I know, Annabon, past half an hour. Okay, I'm going to try to keep it under an hour. Yeah, you will pay money if you have a bond that's negative, a negative percentage. You will pay money to own that bond, by the way. And you're going to get eaten up by inflation. So inflation's 1% now in the UK. You get 1% if you're lucky from a bank. You're a basic 0. How long can you do that for? How long can you do that? Grove Street, Tony, I know there was some repayments in the last couple of days again. So check your Grove Street account. People are being repaid. I know we had some last week, some this week. I rely on readers to give me this information because I got paid back very early. So, I don't see when new repayments come in. Paul says, I'm new to peer-to-peer and building a portfolio. What's the best way to keep track of different investments in different companies so you can see your results? Unfortunately, probably, Paul, the best way is to create an Excel spreadsheet. That's what I personally do, and you can track the XRIR rate of return in there. There isn't really a great tool for doing that. I've had a couple of emails actually recently about people that are looking to develop something that would allow people to track peer-to-peer more easily and just their investment portfolio in general, but spreadsheets are the way to go. Stephen got a payout from Grove Street. Yes, Dave, I understand about the 7%. I misread that. The way that the dividend yield is written for foreign, I'm using google.com, so they write the dividend yield differently. Hi, Gary. Nice to see you. You are late today, Gary Thomas. But don't worry, we're happy you're here. Yeah, I did mention something about the house crowd. It's about the Downs development. Just a quick recap. They basically need money to pay the vendors who are in second charge position. They don't have the money to pay this $2 million plus, and they want to borrow money from somebody else and put us investors in a second charge position. So if you want to re-watch the stream, Gary, I covered that. It'll be archived once we're done with the live. Gary, the loan is the Downs development on House Crowd. Let me give you the exact number of it so you know. HCD 423. Put it in the chat. Sorry, HCD 23. HCD 23. There you go. And Gary, if you were an investor in that Downs development, you will have gotten an email. If you are not, you won't have gotten it. So, but if you watch the stream back, I cover it in depth. Aki, don't ever leave your hobnobs unattended. Hi, Dan. Nice to see you. Dan, you can rewatch the stream on the channel anytime, so don't worry. Yes, I know, half an hour. My arse, you're right. Alan says cufflink overruns are much better than Assetz Capital. Agreed. Yes, if you are not a member of the Lendy Action Group on Facebook, definitely join. I sent out a mass email this week to people about joining the financial thing Facebook group, and I was met with a lot of, I don't do Facebook, which I totally understand. I'm not a huge fan of Facebook, but there's some incredibly useful groups on there. The Lendy Action Group, the Funding Secure Action Group, that I would personally, even if I didn't use Facebook, I would sign up for Facebook just to be a member of those two groups, and the Financial Thing group. Because, I don't always get all of the information for you. A lot of times people will post it in the Financial Thing Facebook group or in the Lendy or Funding Secure Action groups, and there's some things you may have missed that you would only see in those groups. So I highly recommend, even if you hate Facebook and you hate Mark Zuckerberg, sign up for a Facebook account just to join those things. It's definitely worth it. Yeah, so as Mike said, Mike Powell, nice to see you. Thanks for joining us. The first hearing for the Lendy case, which is on behalf of the investors, it's a case about the waterfall situation, which is where Lendy have paid back money from recoveries that investors are saying, well, this is not right. They've taken their own legal counsel against it, and the end of September will be the first hearing in court that happens. That's pretty cool. I'm looking forward to seeing what's going to be the results with that. Dan says he's got some money with Cufflink, had about £500 overrun for 2 months. Yep, it happens in development loans. Dave says he keeps a spreadsheet, which he did himself. Maybe if you ask nicely, Dave will give you a spreadsheet. My spreadsheet is so complicated that I would hesitate to give it to people. I need to clean it up. Maybe I'll clean it up and put it on the Financial Thing website for you guys to download. Dan said he's seen a TV ad, but for Funding Circle, I think, where they're offering loans with no interest for the first year. I haven't seen that one. Yeah, Mike's got some good tips for bank accounts that are paying incentives. Halifax, Lloyd's, RSB. Do you mean RBS or RSB? All paying £100 with minimal requirements. So if you switch your current account to Halifax, you can get yourself £100. RBS, yeah. Cufflink good so far, Ken says. Yeah, I think there's if I had to put it in percentages, I would say on a development loan, 70% chance that overruns happen. When I asked Louis at Loanpad about that, he said sometimes he wants them to go over because they're such good loans that he likes it when they overrun because they're short. Dan says, what do you guys think of Loanpad at the moment? What do you guys think of Loanpad at the moment? I think the Loanpad is one of the best peer-to-peer lending companies. Just my personal opinion, but I like them. They're doing well, no issues. You get paid daily interest. It's pretty cool. And liquidity has been excellent. It's still less than 1 day if you need to exit for whatever reason. One thing I noticed about Loanpad is they're still bringing new investors on board. Usually 20, 30, 40 new investors a week. Dave Dawson says Loanpad is a great place for short-term money. I've used the premium, but put a date in for withdrawal. So if you know you're going to need some money at a set time longer than 60 days, it's worth thinking about. So you can use the premium account. It does have a 60-day withdrawal notice. Norman says, thanks for the heads up on another grocery payment. 2 in 2 weeks. Dan said, are you in the 60-day Premier or the standard Loanpad? I use them both, Dan. I use them both. I mean, I think it, again, comes down to trust in a company. If you like what they do, and put some in the classic account, which doesn't have an account notice on it for a couple of months, 3 months, see how you feel about the investment, and then use the premium if you want. I've been talking to Loanpad. They asked me, what could we do better? And I said, take off the £10 minimum investment. So that way you could get your money invested as it gets repaid. They're doing a site-wide update. They're working on coding that into the system. It's going to take them a while, but I think that's going to be a feature that we'll see in the future. So instead of there being a £10 minimum investment, if you get £1 or whatnot sitting in your account, it gets invested, but it's going to be a while. A lot of talk about ice cream. Yeah, if anybody has a spreadsheet that they would like to share, there's some people in the stream that seems like they could use one. You could always post it in the Facebook group. Dan, the ISAs in, if you're talking about Loanpad, do not have different rates. They are the same. Generally speaking, peer-to-peer ISAs have exactly the same rates as regular investments. Steven says, Loanpad, Crowd, Property, Cufflink, my favorite at the moment. Looking at Blend Network, but not invested yet. Yep, I do like Blend Network too. Don't invest there yet, but Yan, the CEO, is doing some good things over there. Dave Dawson, yes, please make a spreadsheet for everybody if you have time. That would be great. Well, unfortunately, I'm kind of running out of time today. I was going to cover ISAs this week, but I will cover ISAs next week because that's going to be a bit of a topic for discussion. I don't want the stream to go for an hour and 15. Gary, if you are a member of the Facebook group, I will be quite happy to send you a message with the email posted into a message for you. So just drop me a note, Gary, on the Facebook group. And if you're not joining the Facebook group, join up and then I can communicate with you. Or you can send me an email if you want, Gary, at help@financialthing.com, and I'll be happy to forward that to you. So anyway, I'm going to get out of here. Please hit the thumbs up before you leave if you haven't done so. Appreciate you being here. Hope you enjoyed the information. And don't forget to visit my website, financialthing.com, like the video, subscribe to the channel. I will hopefully, all being well, and my neck is fixed for some reason, I'll be back next week, Thursday, same time at 7:30 p.m. And glad you're all here. Be safe. be happy, and take care. Bye.